America's Commercial Real Estate Show is brought to you by Bull Realty. When your business requires proven performance, visit bullrealty.com. And Arnold Golden Gregory, a law firm that makes a difference. Visit agg.com. And Cone Resnick, providing forward-thinking advice to help navigate business and financial issues. Visit coneresnick.com. And by France Media, providing exposure to the world of commercial real estate. Visit francemediainc.com. Welcome to America's Commercial Real Estate Show. Thanks for joining us to lead, learn, and laugh. Learn market knowledge and best practices to lead your company's success. And that's whatever type of company you work with. And laugh, I think we have to have some fun along the way, right? Well, hello, I'm Michael Bull, your host to the world of commercial real estate. Remember, if you have a question or a comment related to this show or about any commercial real estate endeavors, you're invited to contact us through email or Twitter. Our email is info@creshow.com, and our Twitter account is @BullRealty. Well, today we have the pleasure of discussing emerging trends in real estate 2013 with Mitch Rossell and Chuck DeRoca with PricewaterhouseCoopers. Emerging Trends is a publication of PwC and the Urban Land Institute that provides an outlook on U.S. investment and development trends, real estate finance and capital markets, property sectors, metropolitan areas, and other real estate issues. The report draws on formal and informal surveys of real estate executives, investors, developers, and market experts around the U.S., including survey responses from over 500 real estate executives and personal interviews with over 150 industry leaders. Mitch, Chuck, good morning. Thanks for joining us.
Good morning, Michael.
Good morning. Thanks for having us.
Well, glad you guys could call in today and talk to us about this report and tell us a little bit about Emerging Trends report. You know, there are a lot of reports out there that look at the past or look at the last year, but Emerging Trends is unique, right? I mean, it looks forward. And how long has this publication been in existence?
34 years, Michael, and it's probably one of the longest-standing industry forecasts that you'll find for the U.S. real estate, commercial real estate sector. Just going to correct you. One thing you said on the intro. Mm-hmm. It's 900 interviews and online surveys. So wow. The depth and breadth of who we speak to in order to deliver the forecast for 2013 is noteworthy. One other thing I'll mention about ET just on the front end for your listeners and viewers is that it's forward-looking. So it's a forecast of what's going to happen in 2013 through the eyes of those 900 individuals, as opposed to looking backwards in terms of what happened in 2012.
Yeah, I mean, that's very interesting, and I think makes this report very popular. And I've read through most of the report. It is excellent. It's well done. It's well written and very informative. And can you share us what the general theme is that you expect in 2013 from commercial real estate in the U.S.?
Yeah, I'll give you three huge takeaways. And one, if you go back to 2012, one of the questions we asked the survey respondents is their view of profitability for the industry. And it's an interesting question because you're covering 600 different folks, all from different corners of the real estate sector. And the result last year was 86.2% of those people thought that the profitability, as they defined it in their own mind, would be fair or better. This year, when asked the same question, the answer is even more impressive, which is 93.1%. So that really portends well for the asset class for 2013, where the overwhelming majority of folks felt that it was going to be fair or better. If you dig down a little bit closer and sort of picture this bubble chart in your mind, this year 73.9%, so 74%, almost three-quarters of the folks thought the profitability would be good to excellent, whereas last year it was 63% felt the same way. So we've really taken a turn, and those who play in the commercial real estate space feel very good about 2013.
Well, Mitch, it's good to see some optimism after what we've been through in the last several years, isn't it?
Yeah, and it's interesting. The subtitle of Emerging Trends this year sort of tells a story, which is it's a recovery anchored in uncertainty. And I think we'll get into in a bit what some of those uncertainties are, but I think it's optimistic. Two things are driving that. One is that funds are headed to the real estate asset class in what we many of our interviewees refer to as a chase for yield. And what that means is when you look at the yield on other income-producing asset classes, whether they be financial instruments, stocks, dividend-paying stocks, or other bonds, and other structured products, the yield that you get from the real estate asset class remains on a risk-adjusted basis very impressive, very durable, and hopefully inflation-resistant. So capital from around the globe, and I think we'll talk more about where it's coming from, still remains bullish on the asset class. In the sub-theme of investors chasing yield, and Chuck's going to get into this in more detail, we see for 2013 a move towards more local markets. A lot of the capital that's flown into the asset class has been the big cities, what Chuck will refer to as the big six. But in 2013, resoundingly, the forecast suggests that you're going to see a lot of capital flowing into secondary markets, what some people may even think of as tertiary markets, more local investment in real estate, not just the big gateway cities.
Right. All that money can't go in one place. And Chuck, Mitch talked about some of the issues facing commercial real estate in 2013. What are the largest issues we should look out for?
Well, when I look at issues, I kind of look at it in a three-tier breakdown. I think you have to start off and look at the macro issues to start things off. And unfortunately, it looks like there's more downside risk than possibly of a surge in the macroeconomic outlook of things. We still have big global economic concerns. The euro crisis can still have an opportunity to be a crisis in the near future. When you look at China, they've slowed down a bit. I think their latest GDP numbers came out at 7.4, and I think a lot of people can still remember when China's GDP was somewhere up in the 9% range. When we take that down to the U.S. kind of level, we have obviously a big fiscal cliff that kind of lies ahead with a lot of question marks that follow that up. Interest rates continues to be a concern. I'm sure Mitch and I will talk about that in more detail when we focus a little more on real estate. We have debt ceilings that are a concern as well. The election, which is questionable, and we're not sure on the outcome on that overall. And I think then when we drop that down into commercial real estate, that just really is going to affect tenant demand, net operating income of properties, the overall financing of things in general. I mean, when you look at the survey of professional forecasters, it just basically hits 43 economists and asks them how do they feel about expected GDP growth for the United States in 2013. The majority kind of leans more around the 1% range, and that's really below the trend line that we're looking for that continued sustainable growth. So again, question marks kind of surround all around, and I think that's really why people are looking for real estate as an asset class for an investment in a long-term sense of things.
Okay. Well, Mitch, you had me doing the Snoopy dance. Now, Chuck, you got me really worried. Well, Chuck, what are some of the business sectors that will drive commercial real estate in jobs in 2013? Where are the tenants coming from in the demand?
Yeah, this was an interesting outcome in regards to the Emerging Trends Survey. When we saw, 2 or 3 years back when we were deeper into the recession, we actually saw that markets that had more diversity in employment scored better in our overall results. Because if you have more spread out type of employment, if you lose some employment here, you can make up for it elsewhere. What we're seeing now is more of a focus in specific job markets that are going to have sustainable job growth moving forward. And some of those markets are the IT, the high technology type professions. San Jose, for one example, 25% of their employment is in high tech IT type jobs, and they scored third overall in our markets to watch section. Some of the other areas or sectors of interest was healthcare, which continues to get hotter and hotter moving forward. Employment did well in addition to the other two. So those seems to be kind of the markets of interest. The other ones that you have to kind of watch are markets that are focused specifically on regional and local government positions, because that continues to be kind of a question on where they're going to go. And again, we saw that more on the federal government jobs here for D.C., was D.C. kind of fell a bit in the ranks overall because, again, are there going to be any cuts moving forward?
Yep. Okay, we're going to take a quick break. We'll have more emerging trends in 2013. I'm Michael Bull. This is America's Commercial Real Estate Show. We'll be right back. America's Commercial Real Estate Show is brought to you by Bull Realty. When your business requires proven performance, visit bullrealty.com. And Arnold Golden Gregory, a law firm that makes a difference. Visit agg.com. And Cone Resnick, providing forward-thinking advice to help navigate business and financial issues. Visit CohnReznick.com. And by France Media, providing exposure to the world of commercial real estate. Visit FranceMediaInc.com. Welcome back. I'm Michael Bull, and this is America's Commercial Real Estate Show, where we never have a bad hair day, right? Well, if you'd like to know the absolute latest on any commercial real estate related subjects, check out our on-demand show podcasts. Shows are available on subjects like show we did on syndications and group investing, covering some big changes from the Jobs Act, which should allow sponsors to advertise for investors. Another example is a recent show we did on the upcoming tax changes headed our way in 2013, including the 3.8% Obamacare investment tax. There are lots of interesting shows to choose from. You can access the shows anytime on your smartphone or computer, on iTunes, or at the show website, commercialrealestateshow.com. Well, today we're talking about Emerging Trends 2013 with Mitch Rochelle and Chuck DeRoca with PwC. And Mitch, I'd like to talk a little bit more about the lending environment. There's a lot of loans coming due this year. Where's the funding going to come from in 2013 to fund these real estate deals?
Everywhere. How's that for a one-word response?
I like it.
One of the things we ask our participants each year is to rate on a scale of 1 to 9, where 1 is abysmal and 9 is excellent, the availability of debt. This is a really interesting year because under the category, insurance companies wins the prize with a 6.36 rating, meaning that it's on the way towards excellent in terms of availability. Mezz lenders is up considerably, getting a 6.09 rating. CMBS is there too, commercial banks and non-bank financial institutions, which could mean funding vehicles that are in the real estate private equity space, for example. The one takeaway is, if you sort of picture in your mind what that looks like, is all 5 of those asset lending entities are all up over last year, and more importantly, they're all players in the market in a significant way, and this is through the eyes of borrowers. So I think it's a really good story for 2013 that borrowers are confident that there'll be available debt in the marketplace. Now, it may not be on a loan-by-loan basis on the terms that a specific borrower wants. There's still a lot more recourse that lenders are requiring. There's still bigger down payments than we've had in the past. There's higher debt service coverage requirements than we've seen in the past. But on balance, the capital is there. And the one that I circle and focus on the most is mezzanine. The availability of mezzanine for 2013 is considerably higher than it's been in the past. And if you think about the capital stacks of some of the maturing CMBS loans, if there's a first mortgage that's available, but that proceeds from the first isn't enough to take out the existing, and there is mezz money out there, I think we can fix some of these broken capital stacks. And if that happens, I think that the CMBS mess will start to slow down a little bit. One other thing on CMBS, our survey respondents were relatively bullish on the prospect for CMBS for 2013 and somewhat hopeful that the volume for 2013 would be considerably higher than it's been in the last few years. We're sort of stuck at this $30 billion level, and some of our survey respondents were even hopeful that we can get to the $40 or $50 billion level. It's going to depend, however, on what the pricing looks like in the sales of bonds in the fourth quarter of 2012. And if those bonds do well and price well, then a lot more folks are going to try and test the CMBS market. And if there's a distribution channel for CMBS bonds, there's going to be more loans made in 2013.
Okay, and I guess that optimism needs to be checked there a little bit. I mean, if you've got loans maturing, you better get on that situation early and make sure you know what you're dealing with, right?
Absolutely. The sooner you can address a maturing loan, the better for everybody.
Yeah, you don't want to be surprised at the maturity date. Well, how much debt is maturing in 2013 and moving forward? And of that debt, how much is underwater, or at least will need some influx of capital to be refinanced?
Michael, it's harder and harder to answer that question. It's north of $1 trillion maturing in the next few years. The underwater part is the hard part, because the data sources like TREP, for example, and I know they're a frequent guest on your show, they're determining underwater based upon a loan-to-value measurement. And as cap rates compress, values recover, those loan-to-value numbers sort of need to get revisited. So I think that's a tough metric to get your arm around. I think the most important thing to consider is if new loans are getting made and borrowers have the capital to throw a little bit more at the property and there's some mezz money, maybe we can, amongst those three sources of funding, cobble together enough to repay the existing first mortgage and get the property capitalized the right way.
Right.
Interest rates are a lot lower than they were, so you're taking out, obviously, higher priced debt with lower priced debt.
And that should help a lot, right?
I think so, but the issue is what is the pricing of mezz and what's the return expectation for the equity. And on balance, it's probably going to be a very similar cost of capital. It's just that we're allocating it differently today than we did in the past.
Okay, well, thanks, Mitch. And Chuck, let's talk about investment sales volume in 2013. And how much volume do you expect to see? And will some of that come from foreign investors? And will secondary markets really see more action?
Yeah, in talking with our interviewee participants for emerging trends, we heard repeatedly an increase of interest in commercial real estate investing in the coming year, and that's part of our theme as well for the publication, that we do see a spike in investment, specifically within the secondary markets, the larger secondary markets. I know the definition of secondary and tertiary sometimes is a little gray, but again, we find overall that our larger secondary equity markets would do better overall in the survey itself. When you mentioned foreign investors, that's another question that we ask, is what would be the equity source of capital. Foreign investors actually came in number one this year and actually increased as well in our scale that we use to rate them from compared to 2012. So again, foreign investors look like to be the top investors overall, and that was going to be followed up by institutional investors and pension funds. So again, we think there's a ton of equity capital on the sidelines. We think that commercial real estate is a great investment to look at. We think that, again, the equity capital was really just driven by that spread of really the cap rates that you can get, and it depends obviously on the market and the property you're looking at compared to that 10-year treasury. It's a little hard to pass up.
Okay. So all this will contribute to more volume in 2013, you believe?
Yeah, we definitely think there's going to be more volume, but again, we think that focus is really going to be more on larger secondary equity markets that are kind of coming back into play. You know, the price on the major markets, the big six as we call it, the big markets themselves, it's back to pre-recession levels or higher. It doesn't mean I don't think there's not going to still be deals in those markets. It's just going to be a lot more difficult, I think, to put together.
And what do you expect to see for cap rates moving forward in 2013? Do we have a little bit of a leveling out of cap rates, and what do your respondents think about that?
Yeah, our respondents think the cap rates are going to remain fairly stable. I think there's still going to be some compression in markets, again, those secondary markets where you're going to see those purchasing pushing values up a bit. I think you're going to see compression there. Again, in our big six markets, we think that that's really going to stay fairly stable overall. So there's still going to be a ton of deals to be out there, I think, to be had. Again, it's just a great asset class to invest in at this point.
Yeah, I guess there's not a lot of choices out there if you're looking for yield, and real estate should be a safe one.
It should be. And things look good for 2013.
Okay.
Yeah.
Well, stay with us. We have more emerging trends headed your way. I'm Michael Bull, and this is America's Commercial Real Estate Show. We'll be right back. America's Commercial Real Estate Show is brought to you by Bull Realty. When your business requires proven performance, visit bullrealty.com. And Arnold Golden Gregory, a law firm that makes a difference. Visit agg.com. And Cone Resnick, providing forward-thinking advice to help navigate business and financial issues. Visit coneresnick.com. And by France Media, providing exposure to the world of commercial real estate. Visit francemediainc.com. Welcome back. I'm Michael Bull, and this is America's Commercial Real Estate Show. How would you like people to come to your website to hear the Commercial Real Estate Show? Well, you now download a free widget which allows your site visitors to access show videos and audio podcasts right on your website. Just visit commercialrealestateshow.com and look for the widget on the homepage. You can see how it works and easily download it to your site. After you load it, it works automatically. Today, we are discussing Emerging Trends 2013 with Mitch Rochelle and Chuck DeRoca with PwC. And Mitch, I'd like to ask you about the sentiment of investors today or in 2013. Are they going to buy, sell, hold? What do you see there?
Good question. It's one of the things that is unique about emerging trends, and we've been surveying market participants and asking them this question for many years, so you can look at the response over time. The big takeaway there is the trend on selling is increased year over year pretty significantly since the trough, when investors felt like it was absolutely not the time to sell because they thought they'd get clobbered. And similarly, the buying line is ticking up for 2013. So when you have the sell line ticking up in terms of investor sentiment and you have the buy line ticking up, I think that that's a tremendous leading indicator of a pickup in sales volume. So for all of you investment sales folks that are listening to the show, 2013 is going to be a bigger year than 2012 was in terms of sales volume.
Well, thank you for that. And let's look at the outlook for various sectors. Chuck, what do you expect to see in the retail sector?
Well, unfortunately, we think retail is still going to struggle a bit in 2013. We know retail spending has increased a bit, but we still think that there's just a little bit too much space out there, and the need for additional retail is definitely going to be on the low end of the scale. Investment in current retail properties, though, actually fared all right this year in our emerging trend survey results. They were still last of the 5 property sectors, but their increase was a substantial jump for that retail sector. But unfortunately, of the 5, they were 5th overall this year. Okay.
And what about the office sector? What do your respondents say there?
So the office sector is interesting. Clearly, the apartment sector is what many market participants refer to as a crowded trade. Everybody was chasing it. As a result, development is up. Office sector, which has sort of been overlooked perhaps for many years, is really something that's becoming top of mind. And the reason there is we have an overbuilt office, with the exception of a couple of cities, and Chuck perhaps can point to them. We haven't seen cranes in the skyline with speculative construction of office. So the demand's coming back into the market. Companies are growing as the economy grows. Jobs are being created. Those jobs are in offices. And I think there's an opportunity to see an uptick in NOI and an uptick in rents. That's why investors are fairly optimistic about the office sector for 2013.
Yeah, and I guess a lot of that depends on the job market. And what do your respondents believe there? Do they think we're going to have more job growth?
I think it's a market by market phenomenon. But if you look at where we've come from in terms of the job loss in the economy and where jobs have been created, I think that office using jobs and service sector jobs has been where most of the recovery has been. And those are, again, jobs that take place in the office sector. It's the manufacturing jobs and the goods producing jobs where we still haven't replaced those folks in the workforce. So if we are creating jobs, we're creating demand for office.
Well, let's talk about the industrial sector. Do you see more growth there? What do your respondents believe?
The industrial is without a doubt the breakout asset class projected for 2013. The buy, sell, hold rating, 2/3 of our surveyed participants felt that the industrial asset class was a buy, and only 8.5 suggested that it was a sell. So when buyers are outpacing sellers by about 8-1, that can only mean one thing. If I learned anything in sophomore economics in college, is prices are going to go up.
That's right. And we're short on the break here, but what's driving that industrial demand?
A few things. You got to think about industrial in terms of the supply chain. And while retail is still struggling, the consumption of electronics and so forth isn't. And those items, which are everywhere in the marketplace, if they're going to get to your house, they need to be in a warehouse someplace.
Yeah, we got to get our toys, and we want them fast, right?
We want them fast, and so you need to be, well-positioned. Industrial is going to do very well, but there is still demand for the square footage for industrial, and that's what's driving the asset class.
Okay. Stay tuned for more Emerging Trends 2013. I'm Michael Bull. You're listening to America's Commercial Real Estate Show. We'll be right back. America's Commercial Real Estate Show is brought to you by Bull Realty. When your business requires proven performance, visit bullrealty.com. And Arnold Golden Gregory, a law firm that makes a difference. Visit agg.com. And Cone Resnick, providing forward-thinking advice to help navigate business and financial issues. Visit coneresnick.com. And by France Media, providing exposure to the world of commercial real estate. Visit francemediainc.com. Welcome back. I'm Michael Bull, and this is America's Commercial Real Estate Show, where dancing in the studio is allowed, right? We have some interesting shows coming up for you, including a show on social media for business. Be sure to catch shows of special interest to you. Sign up for a once-a-week email announcing the show topic at commercialrealestateshow.com. Well, today we're discussing Emerging Trends 2013 with Mitch Rochelle and Chuck DeRoca with PwC. And Mitch, multifamily has really been hot. Are there any markets where overbuilding could be a concern?
Well, I think you can break multifamily into two sectors. You can talk about the high end of the market, which is the high-income apartments, and then the moderate-income apartments. The high-income side of the equation is really the hottest, and that's where there's less credit risk in terms of the rental income stream than the lower end of the market. The buy sentiment is 43.8% on the high end, but only 28.1% on the low end. So I think it's important to bifurcate that. The thing to think about in multifamily is sort of where we are from a home ownership rate. We're at about 64% of our country owning homes versus 67 at the peak. And the biggest reason for that is this echo boomer component of our population, the 25 to 34-year-olds. There's 80 million of them, and they seem more content to rent. And then the baby boomers, of which I am one, even though I own a home, is 72 million strong. And some of those folks lost money on their homes and are just as well to rent going forward. So I think that there's an excessive demand for rental property at the tenant level versus home ownership. Having said that, I think we've seen the corner be turned in terms of the single-family market. So all arrows seem to be pointing in the right direction. Chuck can get into the individual markets that are hotter than others, but I think the real story is that when you get into a period where home ownership is becoming back in vogue, driven largely by a recovery in prices and this incredibly depressed interest rate environment, and depressed in a good way, and then the apartment sector continues to recover, that's a great story. The one thing to just take away, we're at a 50-year low for interest rates, and we're at a 50-year low for home ownership. And that's an interesting dynamic, which I think is going to drive the continued recovery of the single-family space and sustain the recovery in the apartment sector.
Well, how bullish are your respondents on the residential market rebound?
I think they're very bullish, and I think it's going to vary market by market. One of the things we survey is market sentiment across 51 geographic markets in both development, investment, and in home building. And maybe Chuck can hit some of the high spots in terms of those markets that are strong for home building.
And Chuck, what are some of the markets expected to be hot in 2013?
Well, out of the 51 markets, our top three were San Francisco, New York, and San Jose. And as Mitch mentioned, we have three categories: investment, development, and home building. To get the total aggregate rank, we just summed the three. San Francisco actually takes home the triple crown, though, being number one in investment, development, and home building. So San Francisco comes out across the top as the best market to look at. Some of the other markets I think that kind of stood out, though, as well was Houston. They were up 3 spots to 5th overall. Orange County moved up 5 spots to 9th. Denver, not in the top 10 total rank, but 8th in the investment category. You know, some of the fallers, I guess you got to have to mention as well, was Austin. They were 2nd last year, and they were 7th this year. So they kind of taken a step back. Everyone loves the Austin market. Austin continues to have great growth, But you have to keep in mind, Austin can be a little volatile if you look at some of their past movements in vacancy rates. The biggest faller overall, it's where I'm based, is Washington, D.C. They had the largest loss. They fell actually 11 positions. And we just heard, consistent concerns over overpricing, overbuilding, and then again the possible federal government cuts. But as much as I say that, we also got a ton of quotes in there that's saying that people would stay active in D.C. and prices wouldn't turn them away. So I think even though maybe people are going to be a little more slow to move into the D.C. market, people are still going to keep their eye on it.
Okay. And we've got a lot of listeners to this show from around the world and all over the U.S. And some they may be curious about what's driving these hotter cities, these hotter markets. What's the reason for that?
Well, I would just have to say at this point, when I mentioned earlier the move into secondary markets, I think it's really about price and cap rates. The cap rates, the sub-5 cap rates are found basically in what I define as our big six, which is San Francisco, New York, Boston, D.C., L.A., and Chicago. Maybe not as much in Chicago, but that's really where you kind of find those sub-5 deals. Sub-5 deals in the past haven't always worked out. So I think a lot of investors are going to be a little more slow to move into those type of transactions. So they're really looking to get those cap rates maybe in some of those larger secondary markets that are going to have that employment growth that we discussed earlier.
Right. And I think it's important, Mitch, that you mentioned earlier is that there's a bifurcation between A and maybe C product, and that's across the board. I mean, if you look at industrial, office, or retail, there's obviously some markets where property, one street is doing extremely well, and one down the street's just really suffering, right?
Yeah, and I think I can rip a page out of another publication that we do at PwC, which is our quarterly investor survey, where if you look at cap rates overall, and that publication is in its 26th year tracking cap rates for a quarter century, clearly there's been a compression in cap rates across all real estate sectors. The interesting thing is the widening between, for example, CBD office and suburban office. So while both cap rates have fallen appropriately over time, there is a widening between CBD and suburban, meaning we're getting to the point where investors see a distinction and want the right risk-adjusted return.
Right.
So I think it's a good story for the asset class, and I think when pricing is right, everybody benefits.
Okay. Well, after a quick break, we're going to get to some best bets for 2013. I'm Michael Bull, and this is America's Commercial Real Estate Show. We'll be right back. America's Commercial Real Estate Show is brought to you by Bull Realty. When your business requires proven performance, visit bullrealty.com. And Arnold Golden Gregory, a law firm that makes a difference. Visit agg.com. And Cone Resnick, providing forward-thinking advice to help navigate business and financial issues. Visit coneresnick.com. And by France Media, providing exposure to the world of commercial real estate. Visit francemediainc.com. Welcome back. I'm Michael Bull, and this is America's Commercial Real Estate Show. Today we're discussing emerging trends for 2013 with Mitch Rochelle and Chuck DeRoca with PwC. And Mitch, I'd like to get to your best bets for 2013. What are they?
Always the highlight of the show, Michael. But let me jump into it. So the first one would be concentration on acquisitions in what I'll call budding infill locations. We coined a phrase perhaps this year calling it Infill America. But there are markets that there is demand and there is land and there's the right barriers to entry to make it an interesting place. So some of those markets which we talked about earlier are interesting. Industrial. I'd focus on industrial, great asset class for the aforementioned regions, and if you're in the right distribution or supply chain route, close to rails, close to ports, it looks like it's going to be an interesting play. The flip side of the coin is perhaps backing off apartments a little bit, and the area of caution there is in the lower barrier to entry markets. You may want to back off apartments. The single-family housing funds, they've been all over the headlines. Looks like an interesting play. A lot of investors are interested in sort of jumping into the single-family market as an investor at the low price point. And last thing is the repurposing of obsolete properties, and that could be retail, that could be office, that could be industrial, but the repurposing of assets seems to be an interesting play. Also, the recapitalization, of a well-leased, well-located, high-quality asset. I talked earlier about the advent of mezz financing in the market. Fixing a capital stack remains an interesting bet. Similarly, buying pools of non-performing loans. There's still plenty of them out there. Talked earlier about the $1 trillion of CMBS that's out there. Buying pools of non-performing loans is not for everybody, but that's an interesting play. And the REIT market. The REIT market has held up very well, and I think investors are still bullish on the REIT market. The beauty is it's a liquid asset class if you're talking about the traded REIT market, and being able to jump into real estate, get the income-producing characteristics of it in the form of a dividend, and then if you change your mind, sell the stock. But REITs have held up pretty well, and the prognosis for 2013 for REITs remains strong. And then lastly, locking in long-term financing in this low interest rate environment. Talked earlier about increase in availability of financing for 2013. If you can get it, and lock it in for as long as you can, because this opportunity may not come along in our lifetimes again.
Right. It's incredible rates. Well, where can our listeners get a copy of the PwC report?
Well, we'll make it real easy for you. We'll put a link to our website on the Commercial Real Estate Show's website, so you can click right there. It'll take you to a URL at PwC, and you can download a copy of Emerging Trends. It's absolutely free. It's 90-plus pages, chock full of information, and the operative word there is Chuck, because I want to give some props to my colleague Chuck DeRocco for being co-author and really helping drive the publication this year. And we look forward to chatting with you about it again in the future. Yeah,
we'll put that link on this show page, and we'll put it right on the homepage. It is an incredible report. It is a very good read. I recommend it. And Mitch, Chuck, thanks for spending some time with us today. We appreciate it.
Michael, as always, thanks for having us.
And thanks for having me as well, Michael.
All right. Thank you, gentlemen. And we'd like to thank you listeners for spending some time with us. I'm Michael Bull. Until next week, be sure that you always lead, learn, and laugh, and join us for the Commercial Real Estate Show.